Most creators manage their finances by checking the balance. Not building a P&L, not tracking margin, not separating revenue streams by contribution, just watching the number go up and down, making decisions based on whether it feels okay right now. That works until you're making real money. Then it becomes expensive. A creator P&L is not the same as your tax return. Your tax return is designed to minimize what you owe. A P&L is designed to show you what's actually happening. Most creators conflate the two. That means they see their finances once a year, through a lens optimized for compliance, not clarity. The problem isn't access to the data. Every platform dashboard shows you earnings. Your bank shows you deposits. Your accounting software has the expenses. The problem is that none of it is connected. You have revenue data in 5 different places, expenses mixed with personal spending. No single view of what the business earned, spent, and kept. Not for any given month. Not across all streams at once. Here's what a real creator P&L contains that a tax return doesn't. Revenue by stream, not total gross. Revenue broken down by source. YouTube AdSense on one line. Twitch subscriptions and bits on another. Patreon memberships separate. Brand deals separate. Merch separate. Affiliate separate. The total looks impressive. The breakdown is where the real information is. Which streams are growing, which are flat, which you're overestimating. Most creators who see this for the first time are surprised. 1 or 2 streams are doing the heavy lifting. The others look more significant than they are. That changes the calculus on where to invest time. Cost by category. Not just business expenses. Expenses organized by what they're buying. Production costs, editor, thumbnail designer, equipment as one category. Platform tools and software as another. Contractors and team as a third. Merch manufacturing and fulfillment as a fourth. That structure shows you the cost per unit of content, whether that cost is rising or falling, where spending is growing faster than revenue. Most creators running at $200,000 to $400,000 gross have seen their production category double in 2 years without noticing. Because the total still felt small relative to gross margin by revenue type, AdSense is nearly 100% margin, no direct variable cost. Merch might net 30 to 50% after manufacturing, fulfillment, and platform fees. Brand deals have a variable margin depending on production involvement. Knowing which revenue types are high margin versus low margin changes where you direct your effort. A $50K merch line at 35% margin nets $17,500. A $50K brand deal at 85% margin nets $42,500. Same gross, different business. Net income as a trend, not a snapshot. 1 month tells you a number, a good month or a bad one. 12 months of monthly P&Ls tells you a direction, whether real income is growing, holding flat, or slowly compressing as expenses scale faster than revenue. You can earn $400K in a year and have net income compress 4 months running without noticing. Until you look at the trend. The trend is what tells you whether you're building or running in place at a higher dollar level. The first time most creators build a real P&L, they find at least one of these. A revenue stream they thought mattered. That's actually a minor contributor. An expense category that grew, say, 40% year over year with no revenue increase to show for it. A gross to net ratio worse than they'd estimated. A seasonal pattern that explains why Q1 always feels tight even when the annual number looks fine. Not catastrophic discoveries, just information. Information that was sitting there for years. None of it required a forensic audit. It required a spreadsheet and 2 hours. Building a creator P&L doesn't require advanced accounting knowledge. It doesn't require your accountant present or accounting software or knowing debits from credits. Your platform dashboards give you the revenue. Your bank statements give you the expenses. The structure is simple. Revenue streams across the top. Expense categories down the left, net income at the bottom, monthly columns running right. It's the same format every business uses. The data already exists. It just hasn't been organized. The raw material is sitting in the dashboards and statements you already have access to. The creator who benefits most from this isn't the one with financial problems. It's the one who thinks things are going well and hasn't looked closely enough to confirm it. That creator is making investment decisions, new hires, new equipment, new product lines, based on a feeling, not a number. The P&L converts the feeling into a number. Then the decision has a foundation. This is general education. Your specific P&L structure depends on your income mix, your business entity, and how your expenses are currently tracked. A bookkeeper who works with creators can build the initial structure and maintain it monthly. That cost is almost always worth the clarity. The question worth sitting with: when did you last know your net income for the prior 90 days? Not estimated, not felt, actually calculated. If the answer is at tax time, the P&L is what changes that.